Very good afternoon, friends, and thank you very much for joining us. My name is Ganesh from HDFC Securities, and the topic for today's discussion is this very interesting new fund offer from Mirae Asset Management, which is the Mirae Asset ESG Sector Leaders Fund. What is this fund all about? What is ESG, and what is so special about getting into it through the ETF route? To give us a perspective on that, we have with us Mr. Siddharth Srivastava, who's the ETF product head for Mirae Asset Management, and it's over to you, Siddharth.
Thank you, Ganesh, for having me here. So I'll just switch off my video so that we can concentrate on the presentation itself. So first of all, hello everyone. Thank you for joining us today for this webinar. Before I start, I hope that you and your family is healthy and doing well. Mirae Asset is coming out with India's first ETF and fund of fund on ESG investing. In today's webinar, we'll be talking about this offering, which we are very excited about. But before I talk about this product, I would like to talk about the concept of ESG investing and why it is important to you as an investor and as a human being. Now, while ESG investing or sustainable investing might sound like a very fancy word, but it's very much relevant to the times we are living in. The world we live in right now is increasingly getting impacted by the way companies are functioning. The adverse impact by industries on environment due to issues like pollution, on society due to poor practices with respect to employees, vendors, customers, etc., and on organization itself due to loss of efficiency and shareholder money due to misgovernance is draining the valuable resources we have for our generation and for the future ones. Due to increased globalization, awareness, regulation, and activism, the companies are increasingly getting impacted by non-financial issues related to environmental, social, and governance parameter, or in short, ESG parameters. And the society is also now realizing the importance of these issues in sustainable development of not only the company, but of the world we live in. So companies that integrate planet, people, and profit into its core corporate structure tends to have a competitive advantage over others, which may in turn translate to sustainable profits in the long run, whereas companies which have poor policies on performance on ESG parameters faces higher possibility of negative events, which not only affect the company but also all stakeholders, including investors, which may face significant loss of wealth. Just simply imagine the wealth erosion which has happened for an organization because of the issues pertaining to, let's say, oil spill or labor issues at a plant or data privacy issues pertaining to customer data or fraud or misgovernance or the board issues in a particular company. And all these examples are now very relevant and known to Indian investors, right? There have been multiple incidences where such issues have not only impacted the company, but the investors also who have invested their hard-earned money in those companies. So ESG investing, first of all, is about identifying and investing in companies which have sustainable business model. What do I mean by that? That not only these companies are focusing on earning, generating profit, generating revenue, but they are also focusing on having better policies and practices on ESG parameters. These companies typically have future-ready, robust business model which focuses on creative positive impact on all stakeholders in order to contribute to the society, reduce company specific risk, and have stable wealth generation and overall better efficiency and valuation. Just imagine a company who who is generating profit, who is focusing on revenue, but is also focusing on how it is run, how its employee is being treated, what are the policies pertaining to employee, what are the policies pertaining to vendors over the entire supply chain, what are the policies with which on how it is managing the resources which it is using regarding carbon emissions, regarding waste generation. Isn't it a much more stable and robust company and less susceptible to any negative events? In short, the focus is now on how money is made rather than just on how much the money is made. Because the way you make the money basically sets the future if you will continue generating the money and continue the growth path which we are seeing right now. Because if you are not setting the internal processes right, there can be issues or negative events which can hamper the capability of generating profit or revenues over a longer period of time. So, in short, a portfolio which incorporates ESG investing will typically consist of companies which do not have any significant controversy, have great internal and external policies and practices leading to better resource management, higher efficiency, better brand image, better valuation due to lower cost of capital, and lower possibility of wealth erosion due to negative events. This ultimately leads to stable wealth creation for investors in the long run. So let me go some way back in the history on how this started. This started in developed markets, and Europe is a pioneer in that. What the investors started observing that if you only focus on how well the company is doing in terms of profit and revenues, you are missing out on how the company is structured and how the company is impacting the society and how the company is managing environmental issues. As the globalization increased, these non-financial parameters, E, S, and G, became more and more important. And the companies which weren't focusing on these issues had some sort of event or controversy because of lack of corporate governance structure or poor policy pertaining to environment and society, which just simply destroyed the company. And these single events, single stock level event, created a wealth erosion in the investor portfolio. So it's a known case, right? One or two bad apples spoil the entire basket. So in Europe, it started as a risk management exercise that you want to avoid companies which are not properly governed, which do not have good policies on society, on environment, and hence can have such issues. So while it started as a risk management exercise to avoid such companies, it became much more as a wealth generation exercise also, which we'll talk about in the subsequent slide. So a lot of questions are asked whenever we are talking about sustainable investing or ESG investing. And the one question is ESG charitable investing? Am I simply investing in these sustainable companies, and do I need to forget about the wealth which will be created by such investment? The short answer is no. Empirical studies across the globe has found out that investing in sustainable companies have usually met and often exceeded the performance of comparable traditional investments. This is both on absolute and on a risk adjusted basis across segment, across regions, and over time. So the common notion that investing in sustainable companies which focuses on people and planet along with profit leads to performance penalty clearly doesn't stand true. In fact, the opportunity to sustain strong financial performance along with chance to align your investment with values and ethics has led to exponential growth of sustainable investing across the globe and currently stands at more than $30 trillion, which is more than 11 times the size of India's GDP. Isn't it very intuitive? Actually, just simply consider a company which incorporates such practices along with its continued focus on profit and revenues will obviously have a stable business model and will continue to generate wealth with lower risk. And that is what people have now found out, that while they have only focused on lowering the risk of their portfolio, they have eventually also found out that by investing in such stable companies, companies which are aware about the kind of impact they are creating on all stakeholders and taking all necessary actions to address those impacts, are the one which are not only doing good for the society but continue to generate higher wealth over a longer period of time. And one very important reason on why that is happening is that such companies are able to get money or raise money from the market at a lower cost. Because again, it's intuitive that if you have robust business practices, good policies, performance, then and image, then you are able to raise money from the market at lower cost, and this leads to higher valuation and premium image of the company, and it in the end contributes to the bottom line of the company, and hence the stock prices of these companies rises more and rises more with lower volatility. So in fact, global ESG funds recorded $45 billion of inflows in the first quarter of 2020 amid the COVID-19 pandemic. And ESG ETF have seen net inflow of over $28 billion over this year till July end, which is more than 3 times of what was there in 2019. So even in this volatility in COVID times, ESG funds have continued to see good inflows. And one of the reason was that globally across regions, the ESG compliant companies saw lower volatility than their conventional counterparts. Because these companies were much future ready, were much ready to absorb the impact of this pandemic. Now, talking about it in Indian context, we have seen time and again how some corporates have suffered due to poor governance issues, product issues such as adulteration, environmental damages leading to closure of plant, failure of internal mechanism to detect fraud. So identifying companies with robust ESG policies and performance will help investor navigate such issues and provide an avenue to generate wealth with lower risk. We are observing that people in general are becoming conscious of their consumption and choices. And in front of you, you can see the slide where it highlights that these issues, these non-financial issues, issues pertaining to corporate governance, issues pertaining to plant shutdown, pertaining to labor strikes, have eroded up to 50% of wealth in a very short time of 1 month. And these few cases can impact your portfolio in a very negative manner. So sustainable investing or ESG investing is not only about investing in companies which have good policies and procedures regarding ESG, but it is also about avoiding such controversial companies, and such controversial companies are simply excluded from the portfolio or the ESG portfolio. So as an investor, we should consider ESG investing as not as a charitable investing. We should consider ESG investing as a noble investment strategy that scores on performance and morals both. We have more than enough data, more than enough empirical studies which were done globally, which highlights that investment in ESG compliant companies leads to higher wealth creation, which we have discussed earlier, with lower volatility and lower drawdown. Hence, the return to risk profile of your investment improves drastically. And along with that, you basically incentivize a company to take up these practices, because as an investor, when we are investing in ESG based funds, in ESG compliant companies, we are basically asking other companies to pick up these good practices, and ultimately all this benefits the society also, along with you, who in the end generates higher wealth with lower risk. And based on this, uh, in India now we have been facing the corporate governance issues in several companies over a period of time. There have been number of examples across the years, but now we are also facing issues pertaining to environment, which is affecting the companies, and we are also facing issues pertaining to social pillar, right? Regarding data privacy in this era of digitalization, data privacy is one of the important factors which may affect the company. And then as an EMC, we realize that ESG is now also of utmost importance in Indian context also. It was always important, but in this era of digitalization, in this era when news travels faster than light, ESG becomes much more pertinent, and companies are getting affected by ESG issues more and more. And that is why now we are introducing India's first ESG based exchange traded fund and a fund of fund also. This product is built on the expertise of three entities: Sustainalytics, a global leader in ESG research, which provides the rating and analysis of all the large cap companies; National Stock Exchange, which has used this research to build a true to label ESG index with an aim to capture the performance of companies which have sustainable business model and high ESG rating; and Mirae Asset Mutual Fund, which is now launching an ETF and fund of fund on this index. So just to summarize, here in this particular product, the framework is such that ESG research or scoring of a company is done by an independent third party, which is Sustainalytics. They assess these companies on more than 200 parameters on how well the companies are handling environmental, social, and corporate governance issues. They also judge if there is any ongoing controversy in the company. If there is any ongoing issues or controversy in the company, they flag it out. This controversy analysis and ESG rating is consumed by National Stock Exchange, who have developed this new index which captures the best ESG companies from each sector and also exclude all the controversial companies or the companies in which there are any E, S or G issue. And finally, now since we believe in this product so much, we are coming out with the ETF and the fund of fund on this index. Just to quickly tell you on how this product is constructed, this fund will track the newly launched, as I mentioned, Nifty 100 ESG Sector Leader Index, which tracks the performance of select large cap companies out of Nifty 100. So the base selection universe from which the portfolio is created is Nifty 100, which is the large cap companies. From Nifty 100, all the companies which have high ESG risk are excluded. All the companies in which there is any controversy or any ongoing issue, high or severe, is excluded. All the companies which are involved in ethically questionable businesses like tobacco, alcohol, controversial weapons, and gambling operations are also excluded. And finally, what we are doing is very interesting, is that all the companies each and every company is compared against their global peers within their own industry. So for example, Tata Motor is compared against all the automobile manufacturers across the globe. And if a company is below average in terms of ESG performance or score, that is also excluded. So essentially, NSE is excluding all the companies which have significant controversy, and as an investor, you don't want to invest in such companies. It is also excluding companies which are into ethically questionable businesses. It is also excluding companies which are below average compared to their global peers, and also excluding companies which have high ESG risk. Now, then from each sector, whatever is remaining from each sector, top 75% of companies are chosen from each sector, and bottom 25% companies are excluded. So in the end, what you get is a very focused portfolio of ESG compliant companies across sectors which do not have any controversy, which are better than average compared to their global peers, and which are not involved in any ethically questionable businesses. And hence, you are in a way getting a very good, true to the label ESG portfolio. Currently, the index provides exposure to 15 sectors of the Indian economy by capturing over 48 large cap stocks. Now, what will happen is that this portfolio will be reviewed on a semi-annual basis in the month of June and December. And if a company is performing poorly on ESG issues, they will be excluded and will be replaced by new companies who are doing well on ESG issues. Also, one very interesting thing is, and this will be uh, more good news for you, is that if any company faces a fresh issue or a new controversy which can have a significant impact on the organization and or on the stock prices of the company, those company will be removed from the portfolio as soon as possible by the National Stock Exchange. So as soon as an issue happens and it is flagged by Sustainalytics, the National Stock Exchange removes that company from the index portfolio. So just to summarize the portfolio, by investing in this particular product, you are investing in companies which are selected based on the robust research methodology of a global leader, which is Sustainalytics, a portfolio which is created by National Stock Exchange, a portfolio of companies which are doing well within their own sector, which do not have any controversy, and which are performing better than their global peers on an average. As I was mentioning earlier, that this is not charitable investing. We are not asking you to invest in such companies just because it is doing good for the society or because it is governed in a nicer way, right? Whereas obviously we all want to do that. It's also about generating wealth, creating wealth with lower drawdown or lower risk. And that is what this index or this portfolio does. Since inception, 2014, Nifty 100 ESG Sector Leader Index has given 1.7% higher return than Nifty 50. In a 3-year period, it has given 2.5% higher return than Nifty 50. In fact, this year till date, it has given 5.7% higher return than Nifty 50. And it has done all this with lower volatility or lower risk. So while we were talking about global examples, multiple studies done, that investments in ESG compliant companies leads to wealth creation with lower risk. Same thing is observed in India, that when you invest in such portfolio of robust companies, you will generate typically higher wealth in the long run with lower volatility and lower risk. This index has also outperformed Nifty 50 94% of time on a 3-year rolling return basis. When compared to a typical large cap funds, regular plan of large cap funds, this has outperformed 96% of large cap funds based on 3-year returns and 89% of large cap funds based on 1-year return. Thus, Mirae Asset ESG sector leader ETF and fund of fund will help in satisfying the dual objective for an investor. That is to generate better risk adjusted returns by investing in sustainable and responsible companies. I think it becomes again, I mentioned it earlier, very intuitive. If you are investing within the large cap universe in companies who have better policies and performance across the organization regarding effects on environment, regarding how their plant is run, regarding how their supply chain is managed, regarding employees, regarding vendors. It also focuses on having robust corporate governance and also keeps on focusing on generating profits and revenue. These companies tend to be stable. These companies tend to avoid external shocks. These companies tend to avoid negative events, and that is why they have lower risk and over a period of time can generate higher wealth than their conventional counterparts. This we have observed globally, and through this index, we are observing it in India also now. So this product provides you a very good opportunity to take part in sustainable investing by investing in the true to the label ESG portfolio, which captures such ESG compliant companies which have lower business risk, better resource management, better brand image, and higher sustainable growth opportunity. And you also avoid the controversial companies and the unsystematic price risk associated with it. And you also, as I mentioned, continue to generate higher wealth, which this index has done much more than Nifty 50 with lower volatility and drawdown. Hence, by investing in an ESG portfolio, you are not only contributing to a better tomorrow, to a better society, by incentivizing companies to incorporate ESG practices, but you are doing so with the possibility of generating higher wealth at lower risk. ESG is hence a noble investment strategy that scores on performance and morals and provides an opportunity to grow your wealth in a sustainable way. The NFO of these two funds have already opened on 27th of October and closes on 10th of November 2020. We hope for your participation in this NFO. Happy investing.
Great. Thank you so much, Siddharth. I think it was quite an insightful session with a lot of pointers as to why this fund is has been gaining a lot of prominence over the last 1 year or so. We do have some questions which I will bounce it off to you. Okay, the first one is, how does this compare with the traditional large cap mutual fund?
So typically large cap funds are again constructed from Nifty 100 universe, where you not only focus, it depends on how the fund manager is picking the stock. It can pick based on valuations, it can be growth oriented pick or a value oriented pick. And it is completely dependent on the fund manager view of different sectors or the stock. Here in this index, the portfolio is constructed out of large cap universe only, but it is method driven. It is driven based on the methodology which I talked about, that ESG compliant companies from each sector are chosen, which are better than their counterparts. The controversial companies are excluded, and all the companies which are below average compared to their global peers are also excluded. So compared to a large cap fund, which again is constructed from a large cap universe, and the stock picking and the sector allocation is driven by a fund manager view of the market. This is more a rule based driven portfolio where, as I mentioned, the stocks are picked on the method which is disclosed for this particular ETF.
Great, thank you for that. The next question is on the tax treatment. How is the taxation calculated?
So ETF continues to be categorized as an equity-oriented scheme and is taxed like a normal equity mutual fund, whereas the fund of fund, interestingly, will also be categorized as an equity-oriented scheme and taxed as an equity fund, because more than 90%, or rather entire corpus apart from some minor cash component of the fund of fund, will be invested in the ETF itself, in the equity ETF. And based on the new regulation, if the fund of fund is investing in equity ETF, then that fund of fund will be categorized and taxed as a equity oriented scheme.
Great, thank you. The next question is, you spoke about the review of the index or the rebalancing. So what is the frequency of that particular activity?
So there are two ways on which reviews are done. One is a scheduled review, which will happen twice in a year, in June and December, when the entire portfolio will be reviewed based on the fresh research done by Sustainalytics. The National Stock Exchange will review the entire portfolio. The poor performers will go out. The good performers, better performance will come in. The second changes can happen because of any issue or controversy which may happen in any company. If there is any company in which a fresh issue regarding corporate governance or environment or social issues have happened, and these controversy or issue is significant, that it dents the brand image of the company, it dents the long-term prospect of the company, such companies will be removed from the portfolio as soon as possible without waiting for the scheduled rebalancing, which happens twice a year.
Great, thank you for that. The next question is, okay, usually India's large cap entities are the ones who have a good ESG score and also have a significant ownership in the Nifty 100 ESG sector index. So will we have a churn in small cap companies as well, from Mr. Ashutosh?
So the reason why you'll typically find large cap companies having good ESG score is that they, because of the disclosures, they tend to disclose more in terms of environmental, social, and corporate governance issues. And that is why we have restricted ourselves in the large cap universe only, because here you can assess companies in much more detail and get the much more pertinent ESG analysis and select the companies. So here in this fund, the companies will only be selected from the Nifty 100. We won't go to mid caps or small caps for the portfolio construction.
Great, thanks for that. The next question is, how frequently is the ESG rating done, from Mr. Chandrasekhar?
So I think there are multiple ways to answer it. The major refresh of the ESG rating is typically done once a year, when the company discloses in its annual report on what sort of steps it has taken regarding environmental, social, or corporate governance issues, right? So that typically happens once a year, and that is when the ESG rating of the company is, in a way, majorly redone. But on an ongoing basis, any news pertaining to a company is tracked. If that news is relevant and significant, those news and subsequent disclosures by the company is considered, and ESG rating because of that, or controversy flag because of that, can be impacted somewhat, but major review is done once a year.
Great, thanks for that. The next one is on the index again. What is the base index for this fund, from Mr. Anil?
So Anil, I think name itself is very intuitive. The index name is Nifty 100 ESG sector leader. So the base is Nifty 100 from which the final portfolio is created. ESG is used as a parameter for selection, and sector leaders means from each sector the best companies are chosen. So the base is always Nifty 100 when the index review is done.
Okay, the next question is, what is the benchmark to assess the fund performance?
So
From Mr.
since
Ramakrishna.
Yeah, so Ram, basically, since this is an ETF, it's a passive fund. The benchmark is very important. The benchmark here is the newly launched uh, benchmark by National Stock Exchange, Nifty 100 ESG Sector Leaders Index. It is calculated on a real-time basis on National Stock Exchange. So it is not only a benchmark, but all the investments done by the ETF will be done in the companies which are forming part of this index in the exact same proportion. It is similar to how a Nifty 50 ETF is when where in the Nifty 50 ETF you only invest in 50 companies which are forming part of Nifty 50 in the exact same proportion. Here also the ETF will invest only in the companies which are part of Nifty 100 ESG sector leader index in the exact same proportion. So in the end, the aim is to give you performance which the index is generating.
Great, thank you for that. The next question is, how does ESG investing specifically through the ETF route compare with ESG investing through the traditional mutual fund route?
I think that's a very interesting question, and we have been getting that question a lot. So see, ESG analysis or review is very intricate thing. It requires a lot of domain expertise, and that is why we believe that ESG analysis of a company should be done by an expert. And that is what is the main differential here. In this ETF, which is based on an index where the ESG rating and controversy analysis is done by a global leader called Sustainalytics, and they have a track record of over 25 years. They have more than 700 professionals, and they do it in a very objective manner. They analyze over 200 parameters to rate one company, and they have been doing it globally, across regions, across decades. And we feel when a research comes from such objective provider, it gives you more unbiased view of ESG performance of a company, because we in India typically have not been doing it historically, and thus a passive fund using a more objective ESG score for portfolio construction typically provides you an unbiased portfolio compared to an active fund who is driven by on how fund manager or his investment team analyzes the performance of companies on ESG parameters.
Great, thank you for that. The next question is, will the screening of parameters be based completely on Sustainalytics data? Are there any other leading vendors on ESG matters? And the follow-through question on that again, are the screening parameters subject to be modified from time to time?
So, what the ESG research is sourced from Sustainalytics, and that is done by National Stock Exchange on an independent basis. They consume the ESG rating and the controversy analysis, which is given by Sustainalytics. The product involvement regarding if company needs to be excluded based on doing businesses in tobacco, liquor, gambling, adult entertainment, or controversial weapons, that is done by National Stock Exchange itself. And by mixing these data, the portfolio is constructed. Whether the research methodology can change or not, it depends if it needs to be done to improve the quality of the ESG research. For example, a couple of years back, Sustainalytics changed its methodology, and now it gives corporate governance as much importance as it is giving to E and S pillar. And I think that makes the research methodology much more relevant to Indian audience, because here corporate governance is also a major issue in our Indian market. So the change in methodology done 2 years back by Sustainalytics, by the research provider, made the product more relevant to the Indian investor. So The methodology may change. It is very less frequent. It is usually done after a huge consultation. But if it is done for the betterment of the product.
Great. Thank you for that. So with that, we will come to the end of the session. Can I request you one more time to just cover the specifics of when the fund is opened, when does it close, and over to you for your closing remarks as well, Siddharth.
So thank you, Ganesh. The fund has already opened and the NFO for both the ETF and the fund of fund is live. It opened on 27th of October and it closes on 10th of November 2020. It is up to the investor whether they want to use a ETF route for investment or the fund of fund route for investment. So we have provided both the options to the investors. Just to quickly summarize, investing in sustainable companies, in companies which have robust business model, which have good governance practices, which take care of society and the impact they are doing on environment, is not charitable investing. It's also about creating higher wealth with lower risk, with lower volatility. So ultimately what you do is you do good for the society. You basically incentivize companies to basically get ESG compliant, along with the basically generating wealth with a lower risk profile. So I think it's a win-win situation, right? If you can do good for the society, good for the environment by investing in robust business model, in stable companies, by avoiding controversial cases, by avoiding company specific events, and generate higher wealth with lower risk, what more can you ask for? So it's a very noble product or strategy, if you can say, which not only does good for the society but for your portfolio as well. So we hope for your participation in this NFO. In case of any queries, just do get in touch with HDFC Securities or with Mirae Asset. We'll be happy to answer any further queries which you have.
Great. Thank you so much, Siddharth, and thank you so much, dear investors, for sharing your evening with us. We do hope that you found this session insightful and you found this an exciting investment avenue as well. Thank you so much, investors, and thank you, Siddharth, for sharing your time with us.
Thank you, Ganesh, for having me here. Thank you.
Yeah, we can close the call now.